We wrote a piece on gold about 13 years ago. The point of it was to understand different central banks and their currencies. You've heard us talk about fiscal dominance. And what fiscal dominance says is if government debt is too high, the central bank can't maintain high real interest rates as it would otherwise, because it would bankrupt the government. So when you look at the central bank balance sheet, how do you measure leverage? Well, we have a way that we described in our paper. It's a way that a couple hundred years ago, when you had harder gold standards, that analysts or accountants would measure the leverage of a central bank. Whereas the EMs, formally defined, M0 and M2, very low money liabilities and very high numbers of ounces. In fact, Russia and Kazakhstan, which have bonds in their money, in rubles or tenge, paying high interest rates, you could take all your M0, all your cash in circulation, and show up at the central bank and get gold at market prices, meaning at the exchange rate price at the 5,000-ish dollars an ounce that it's worth on the screens right now. A lot of people ask about the dollar's status and whether it will lose it and what happens if it does. I'll just give an example of two countries. One is a poster child for fiscal dominance, Japan. So Japan has less than 3% of its M0 backed by gold. When we wrote the piece a few weeks ago, paid less than 2% in yen. South Africa, on the other hand, has 60% of its M0 backed by gold, and their bonds pay more than 8%. So it's pretty interesting that this framework we've used for over almost 15 years now has been extremely consistent with these asset price outcomes that seemed to catch a lot of the market by surprise. This framework explains it pretty neatly.